What I'm about to explain to you today, Saturday, February 24th, may turn out to be one of the most important structural turning points in the precious metals market in decades. Two completely different financial worlds are colliding right now in a way we have never seen before, and the consequences could redefine how gold and silver trade going forward. On one side of this collision sits Binance, currently the largest cryptocurrency exchange in the world. Within just weeks of launching perpetual futures contracts tied to gold and silver, Binance recorded more than $70 billion in cumulative trading volume across those contracts. $70 billion. And that number is not theoretical liquidity. It is actual volume flowing through synthetic exposure to precious metals on a 24-hour, 7-day-a-week platform. On the other side, physical silver inventories on COMEX continue to decline steadily while the March to May contract roll is running at approximately 30 million ounces per day. One analyst ran the numbers and projected that at this current pace, COMEX could theoretically exhaust available silver inventories by February 27th. That date is only days away. Now, does that automatically mean the silver market literally runs out of metal on February 27th? Not necessarily. These projections assume that the current pace continues unchanged. New supply could enter. Contracts could be rolled forward instead of demanding delivery. Incentives could be introduced to discourage physical withdrawal. But the fact that a serious analyst is even willing to attach a near-term date to potential inventory exhaustion tells you how tight the physical side of this market has become. At the same time, global traders are pouring capital into synthetic exposure through crypto-native platforms that allow uninterrupted access to precious metals price movements. The traditional restrictions of market hours are fading away. The boundary between cryptocurrency derivatives and commodity derivatives is dissolving, and the implications for physical holders and paper traders alike are enormous. Let us begin with Binance and that $70 billion figure, because many traditional precious metals participants are not fully appreciating what that represents. Binance introduced perpetual futures contracts for gold and silver denominated in USDT, including the XAU USDT and XAJ USDT trading pairs. Within weeks of launch, cumulative trading volume surpassed $70 billion. To put that into context, many traditional commodity exchanges would require months to generate that level of volume in comparable contracts. What this signals is overwhelming demand for round-the-clock synthetic exposure to gold and silver price movement. Traditional markets close, COMEX operates within defined hours, the London fix occurs at scheduled times, crypto exchanges never close, traders can access precious metals exposure at 3 in the morning on a Sunday if they choose. This represents a fundamental shift in how these markets function globally. Geopolitical events do not respect exchange hours. If a major development involving Iran or another geopolitical hotspot unfolds at midnight on a Saturday, historically traders would have to wait until futures reopen to respond. By then, the move might already be priced in. With 24-hour trading, exposure can be adjusted instantly. The key question is this. When $70 billion flows through synthetic gold and silver contracts, how does that relate to the physical metal itself? These perpetual futures are cash-settled derivatives. They track price, but they do not require physical delivery. No bars change hands, no vaults open. It is pure price exposure. In theory, unlimited synthetic exposure can be created without affecting physical supply. $1 trillion could trade in XAG USDT contracts without a single ounce of silver physically moving. However, these synthetic markets are not entirely detached from physical reality. Arbitrage mechanisms exist to keep perpetual futures pricing aligned with spot markets. If Binance Silver were to diverge significantly from COMEX pricing, arbitrage opportunities would emerge, and traders would act quickly to close those gaps. So while the synthetic market does not directly consume metal, it remains tethered to the physical market through pricing relationships. The critical question becomes, what happens if physical supply tightens so dramatically that arbitrage cannot maintain alignment? What happens when paper exposure grows far beyond accessible physical inventory? That scenario appears increasingly relevant. Now let us turn directly to COMEX, where the physical dimension of this story unfolds. Silver inventories backing futures contracts have been declining while the March to May contract roll is occurring at approximately 30 million ounces per day. That pace reflects contracts being rolled forward, or in some cases demanding delivery. Investment specialist Carol Merks analyzed this data and concluded that at the current pace, COMEX inventories could theoretically be depleted by February 27th. He further noted that from April onward, the risk of a physical shortage increases unless meaningful inflows arrive in the coming weeks. It is important to approach such projections carefully. Predictions of exchange inventory exhaustion have surfaced before, and the system has historically adapted. Contracts get rolled, premiums are paid to avoid delivery, metal is sourced internationally, the system possesses flexibility beyond simple arithmetic calculations, but when analysts begin attaching specific near-term dates to potential depletion scenarios, it signals that conditions have tightened materially. Now consider the futures curve. After adjusting for financing costs such as the secured overnight financing rate and storage expenses, the March to May silver spread is approaching backwardation. This technical condition carries serious implications. Under normal circumstances, futures markets operate in contango, meaning future delivery prices exceed spot prices. This reflects storage costs and capital financing. Holding physical silver requires vaulting and ties up capital that could earn interest. Futures pricing compensates for those carrying costs. Backwardation is the opposite structure. Spot prices exceed futures prices. When adjusted for financing and storage, backwardation indicates that physical metal available today commands greater value than future delivery. This typically signals immediate supply tightness and urgent demand. Silver is approaching this condition. Even if the raw spread appears in contango, adjusting for carrying costs shows that physical silver today may be priced more aggressively than silver months forward. That suggests strain within the physical market. Backwardation alters incentives throughout the supply chain. Producers may be inclined to sell immediately. Speculators may interpret it as confirmation of scarcity. Buyers needing immediate delivery must pay premiums. Rising futures prices can intensify the dynamic, encouraging speculative demand while producers withhold supply, anticipating higher prices. This creates a feedback loop where tightening supply contributes to higher prices, which then further tightens supply behaviorally. Historically, such structural setups have preceded sharp price moves. In 2011, silver rallied dramatically. In 2020, it doubled from pandemic lows. Similar structural conditions preceded those moves. Meanwhile, gold volatility has climbed to its highest level since 2008, the year of the global financial crisis. Elevated volatility reflects uncertainty, rapid repositioning by major players, and widening outcome ranges. High volatility does not dictate direction, but it strongly suggests that large moves are likely. When volatility reaches levels comparable to 2008, markets rarely drift quietly. Combined with tightening physical silver supply and expanding synthetic trading volume, the ingredients for structural change are clearly present. This convergence demands close attention because the interaction between synthetic derivatives and physical scarcity may determine whether silver experiences gradual repricing or a sudden disorderly adjustment in the weeks ahead. Now let us expand this framework further because the structural changes unfolding are not isolated to one exchange or one contract. They represent a broader transformation in how financial markets operate. Continuous trading is becoming the norm rather than the exception. And that shift alters risk, liquidity behavior, and price discovery mechanisms across asset classes. The CME Group recently announced that beginning May 29th, crypto futures and options will trade 24 hours per day, 7 days per week on CME Globex, pending regulatory approval. This marks a decisive acknowledgement from one of the world's largest derivatives exchanges that continuous markets are the future. Trading confined to traditional hours is gradually being replaced by always-on liquidity. CME has reported record notional volume of approximately $3 trillion across crypto futures and options in 2025, and $3 trillion year-to-date in 2026. Average daily volume has risen roughly 46% year over year, while futures average daily volume is up around 47% year over year. These are not marginal increases. They signal institutional scale adoption of round-the-clock derivatives trading. Once continuous trading becomes normalized for one asset class, competitive pressures encourage expansion to others. If crypto trades 24 hours a day, investors will question why gold and silver remain partially restricted by exchange hours. Over time, that pressure could push precious metals markets toward continuous pricing as well. Binance has already moved in that direction. This evolution matters because it changes the risk profile of holding positions. Historically, weekend gaps represented a significant exposure. If major geopolitical news broke on Saturday, prices might gap sharply when markets reopened Sunday evening or Monday morning. Traders were unable to hedge during that closed window. In a continuous trading environment, those gaps shrink or disappear as markets adjust instantly. With instant price adjustment comes increased responsiveness, but also faster volatility. Repricing events may unfold in real time without cooling off periods provided by market closures. That accelerates both rallies and sell-offs. It also means that capital flows between synthetic derivatives and physical markets may respond more dynamically to stress. Returning to the $70 billion in Binance precious metals perpetuals, we must consider what this synthetic liquidity represents. One interpretation is substitution. Traders who might otherwise have demanded physical silver or taken delivery on futures are choosing instead to express their views through cash-settled perpetual contracts. That reduces immediate physical strain but increases notional exposure. Another interpretation is additive demand. Crypto-native participants who never interacted with COMEX or physical bullion are now gaining exposure to silver price movements through familiar infrastructure. That represents entirely new interest in precious metals pricing without corresponding physical demand. If this view is correct, synthetic growth may coexist alongside tight physical inventories. A third possibility is emerging dislocation. Synthetic markets may expand faster than the physical system can support through arbitrage. In normal conditions, arbitrage keeps pricing aligned, but if physical supply becomes genuinely scarce, the arbitrage mechanism could weaken. At that point, synthetic pricing might no longer perfectly track physical availability. This brings us back to the February 27th projection. If the March to May contract roll continues at approximately 30 million ounces per day and meaningful inflows do not materialize, inventories tighten further. Something would have to adjust. Deliveries could be incentivized through premiums. Contracts could be encouraged to roll rather than stand for delivery. Metal could be sourced internationally from London, Zurich, Singapore, or other storage hubs. The system has demonstrated resilience in past episodes of strain. Inventory depletion warnings have appeared before, yet the exchange structure persisted. It is entirely possible that similar adaptive mechanisms will operate again, but the scale and speed of current synthetic growth add a new dimension that was not present in prior cycles. Now consider gold volatility at levels last seen during 2008. Volatility reflects uncertainty. It indicates large players are repositioning, and that expectations regarding macroeconomic outcomes are shifting rapidly. High volatility environments magnify leverage risk. Positions that appear manageable in calm conditions can become unstable quickly. Silver itself recently experienced one of its sharpest declines since 2011, followed by a rapid recovery. That pattern underscores the instability inherent in the current environment. Rapid swings are becoming normal rather than exceptional. When volatility expands, capital relocates more aggressively between asset classes. In a high volatility regime combined with tightening physical supply and expanding synthetic exposure, the market structure becomes more fragile. Price moves can feed on themselves. Rising prices encourage speculative participation. Speculation tightens perceived supply. Tight supply reinforces price momentum. The reverse can also occur during sharp corrections. Let us examine backwardation more deeply because its potential confirmation would amplify these dynamics. When spot silver trades above forward pricing after adjusting for financing and storage, it communicates immediate scarcity. Buyers are willing to pay more today than for future delivery. That sends a strong signal throughout the market. Producers may accelerate sales to capture elevated spot pricing. However, if producers anticipate continued price appreciation, they may delay supply. Investors holding physical metal may become less willing to part with inventory. Speculators may interpret backwardation as validation of a supply squeeze narrative and add to long positions. At the same time, industrial consumers who require silver for manufacturing must secure supply regardless of price direction. Solar panel production, electronics manufacturing, and electric vehicle components continue to generate steady industrial demand. If immediate supply tightens, industrial buyers may be forced to pay premiums, reinforcing upward pressure. However, backwardation can also attract arbitrage capital. Traders may source physical metal, deliver into the exchange, and capture the premium between spot and futures pricing. That mechanism can relieve pressure before a true shortage develops. The presence of this natural market response complicates projections of exhaustion. Now we must weigh bullish and bearish interpretations simultaneously. The bullish case rests on documented inventory declines, approaching backwardation, expanding derivative volume, and elevated volatility. Together, these suggest a structurally tight market vulnerable to sharp repricing. The bearish case emphasizes historical resilience. The exchange system has previously navigated inventory strain. Synthetic volume may actually diffuse pressure by allowing traders to express views without demanding delivery. Volatility cuts both ways. A broad risk-off event could trigger liquidation across metals alongside other assets. It is also important to remember that continuous trading does not eliminate systemic risk. It merely redistributes it. In a 24-hour environment, forced liquidations can cascade without pause. Liquidity during off-peak hours may be thinner, increasing slippage. Funding rate dynamics in perpetual contracts can shift rapidly, altering positioning incentives. The convergence of crypto derivatives and traditional metals markets introduces operational complexity. Traders who understand funding rates, margin requirements, and arbitrage dynamics may find opportunity. Those who do not fully grasp these mechanics may encounter unexpected risks. What we are witnessing is not merely a short-term squeeze narrative. It is a structural evolution in market architecture. Synthetic exposure is scaling rapidly. Physical inventories are tightening. Volatility is elevated. Continuous trading infrastructure is expanding. These forces interact simultaneously. Whether this culminates in a dramatic silver spike, a gradual repricing, or a temporary stabilization depends on how supply, demand, and derivative positioning evolve in the coming weeks. The February 27th projection serves as a focal point, not necessarily a deadline, but a reference marker for observing how the system responds under stress. As we move into the final phase of this analysis, we must translate structural insight into strategic positioning. Understanding dynamics is insufficient without disciplined risk management. The environment ahead favors preparation over prediction, flexibility over conviction, and data over emotion. The forces are visible, the timeline is tightening. The next developments will reveal whether synthetic expansion and physical scarcity can coexist peacefully, or whether reconciliation between paper claims and metal availability forces a decisive market adjustment. Now we arrive at the critical question. What does all of this mean for positioning, risk, and the potential trajectory of silver and gold from here? The structural forces are visible. The data is public. The interaction between synthetic growth and physical tightness is unfolding in real time. The challenge is determining how these forces resolve. Let us begin with the fully articulated bullish case. Physical silver inventories on COMEX are declining, while the March to May contract roll runs near 30 million ounces per day. One analyst has projected exhaustion by February 27th if that pace continues. The futures curve, when adjusted for financing and storage costs, is approaching backwardation. That condition historically signals immediate supply strain and has preceded significant upward price moves in past cycles. At the same time, demand for price exposure is expanding dramatically. $70 billion in Binance gold and silver perpetual futures volume within weeks indicates broad appetite for precious metals participation. Continuous 24-hour trading infrastructure allows global capital to engage instantly with metals pricing regardless of time zone or exchange hours. CME's move toward round-the-clock crypto derivatives trading further normalizes continuous markets. Gold volatility at the highest level since 2008 suggests that large players are repositioning aggressively. High volatility environments often precede decisive price moves. When supply tightens and volatility expands simultaneously, markets become susceptible to rapid repricing. If physical availability proves insufficient relative to paper claims, prices may need to adjust upward to ration demand and incentivize supply. Industrial demand remains a structural component of silver's profile. Solar panels, electronics manufacturing, and electric vehicles all require silver inputs. Mine supply growth has not consistently kept pace with expanding industrial consumption over multiple years. If immediate physical inventories tighten further, industrial buyers may compete more aggressively for available supply, potentially amplifying price pressure. In this bullish framework, a squeeze dynamic becomes plausible. Synthetic exposure expands while vault inventories contract. If enough participants attempt to convert paper exposure into physical delivery simultaneously, the imbalance could force accelerated price adjustment. Even without widespread delivery demands, awareness of tightening conditions alone may attract speculative capital anticipating higher prices. However, a disciplined analysis requires equal attention to the bearish scenario. Predictions of exchange inventory exhaustion have appeared before. The system has repeatedly adapted. Contracts roll forward rather than standing for delivery. Premiums are paid to encourage settlement flexibility. Metal can be sourced from global hubs, including London, Zurich, and Singapore. Exchange inventories are not the sole reservoir of global supply. Synthetic growth may also relieve immediate pressure. If traders gain price exposure through cash-settled perpetual contracts instead of demanding delivery, physical strain may diminish. The existence of deep synthetic liquidity allows speculative interest to express itself without draining vaults. In that sense, paper markets can absorb demand that might otherwise impact physical inventories. High volatility introduces two-sided risk. In March 2020, gold initially declined sharply alongside broader markets during forced liquidation before recovering strongly. A similar liquidity event could pressure metals temporarily even if longer-term fundamentals remain constructive. Margin calls and cross-asset deleveraging can override supply narratives in the short term. Backwardation, if confirmed, may trigger arbitrage responses that stabilize inventories. Traders can source physical metal, deliver against futures contracts, and capture premium spreads. That natural market mechanism has historically prevented persistent shortages. The mere approach of backwardation can attract sufficient supply to rebalance pricing relationships. The relationship between crypto-native perpetuals and traditional futures markets remains developing. While arbitrage typically maintains price alignment, operational disruptions, liquidity imbalances, or funding rate distortions could create temporary divergences. Such events could produce confusion rather than clean directional moves. Given these competing forces, strategy becomes paramount. The first principle in this environment is respect for volatility. With gold volatility at levels not seen since 2008 and silver demonstrating sharp multi-week swings, leverage carries elevated risk. Positions sized comfortably in calm markets may become unstable quickly when daily ranges expand. The second principle is clarity regarding exposure type. Physical metal, allocated storage, exchange-traded products, futures contracts, and perpetual derivatives all carry different counterparty and liquidity profiles. If one's thesis centers on physical scarcity, direct ownership or allocated storage aligns most closely with that view. Synthetic instruments provide liquidity and flexibility, but introduce counterparty and funding considerations. The third principle is adaptation to continuous markets. In a 24-hour trading environment, price moves can occur at any time. Risk management tools such as stop-loss orders, position sizing discipline, and diversified exposure become increasingly important. Passive monitoring is less viable when markets never close. The fourth principle involves understanding cross-market mechanics. Funding rates on perpetual contracts can shift rapidly depending on positioning imbalance. Futures spreads reflect financing costs and expectations. Arbitrage relationships can compress or widen. Navigating this environment effectively requires familiarity with both traditional commodity structures and crypto derivatives mechanics. Looking forward, the coming weeks will serve as a stress test. If COMEX inventories stabilize through inflows or reduced delivery pressure, concerns about imminent exhaustion may fade. If inventories continue declining and backwardation intensifies, bullish narratives will gain credibility. The February 27th projection acts as a reference point for observing how supply dynamics evolve. What matters most is not the exact date, but the system's response to tightening conditions. Does liquidity appear quickly when incentives rise? Do spreads normalize? Does volatility compress or expand further? Each of these signals provides insight into structural resilience. Ultimately, markets reconcile discrepancies between supply, demand, and pricing through adjustment. That adjustment can occur gradually through incentives and arbitrage, or abruptly through repricing. The coexistence of $70 billion in new synthetic metals volume alongside tightening physical inventories creates a dynamic equilibrium that may not remain stable indefinitely. Investors must recognize that both scenarios remain plausible. A dramatic upside move driven by perceived scarcity is possible. A temporary stabilization or even correction driven by liquidity responses is equally possible. The environment does not reward complacency. It rewards preparation, disciplined sizing, and awareness of structural context. The structural convergence between crypto derivatives and traditional precious metals markets is real. Continuous trading infrastructure is expanding. Synthetic exposure is scaling rapidly. Physical supply metrics show strain. Volatility is elevated. These are not isolated statistics. They are interconnected signals. Whether this period ultimately becomes remembered as the prelude to a major silver repricing or as another episode of stress absorbed by a resilient system will depend on how participants react in the days ahead. Markets are adaptive organisms. Incentives shift behavior. Prices transmit information. The responsibility rests with each participant to assess risk tolerance, time horizon, and exposure type. Large opportunities can emerge from structural change, but so can significant volatility. Prudent strategy involves balancing conviction with caution. As of today, Saturday, February 21st, the convergence is unmistakable. Synthetic growth accelerates. Physical inventories tighten. Volatility expands. Continuous trading normalizes. The pressure builds. What happens next will reveal whether the silver market transitions into a new pricing regime or reverts to familiar patterns of adjustment. Either outcome carries implications that extend beyond a single contract cycle. Monitor the data, observe inventory trends, watch futures spreads, track volatility, remain disciplined. In environments like this, clarity and preparation often matter more than prediction. The forces are in motion. The structure is shifting. The coming weeks will determine how the balance between paper exposure and physical metal ultimately resolves.